It is Wednesday, April 26, 2017. I'm Gord Long. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates U.S. economic developments. Therefore, the slides this morning will focus on our other three report areas of our monthly report, the global risk, macro, and regional developments. As I often do, I'd like to tie them together into a discussion. This month, I'd like to focus on the following subject areas. Specifically, the Trump administration's expectations and promises which they have set, likely roadmaps they are going to face, policy exposures, and possible coming shocks. A top priority of presidential candidate Donald Trump, which he emphasized on the campaign trail, was to drain the swamp when he immediately arrived in Washington. I can't help remembering that old axiom my grandfather used to cite. It's hard to remember you're here to drain the swamp when you're up to your ears in alligators. As investors, let's consider what has happened to the Donald in his first 100 days and how we might position portfolios and our risk mitigation strategies going forward. First, expectations and promises. What the Trump trade was and why it may be over. They called it the Trump trade, the simultaneous surge in U.S. stocks, Treasury yields, and the dollar that followed Donald Trump's victory in the U.S. presidential election. Investors had heady expectations for the Republican president and the party's majorities in Congress. Trump's America First agenda included promises to move quickly to 1. Cut corporate taxes, 2. Loosen reams of regulations, and 3. Spend $1 trillion in infrastructure, an amount likely to drive up U.S. growth and inflation. There's less excitement in the markets now, however. Yes, American stocks are within spitting distance of all-time highs, but the rally is being sustained by companies other than ones expected to be big Trump beneficiaries. The U.S. dollar index is up less than 2% since Trump's election on November 8th, and as this chart shows, the government's 10-year borrowing costs are closer to pre-election levels than their post-election peak. As the president approaches his 100-day mark in office, many are asking, is the Trump trade over? Let's look at what rose after Trump's win. Within 6 weeks of Trump's victory, benchmark stock indexes had reached fresh records. The U.S. dollar index gained nearly 6%, and the 10-year yield jumped by more than 75 basis points. Stronger growth and higher prices were seen as bringing an end to the long stretch of lower than desired inflation that has hampered growth in many countries since the 2008 financial crisis. Among equities, the biggest winners were linked to expectations of a big fiscal boost. Banks would profit from deregulation, the thinking went, and small cap stocks would gain from corporate tax cuts. The promise of massive infrastructure spending helped shares of select construction and materials companies do better than the U.S. stocks at large. What accounted for the optimism? It looked like the end of political gridlock. The installations of a unified Republican government in Washington, D.C. presumably meant that pro-growth policies espoused by Trump on the campaign trail could be implemented swiftly. Measures of confidence proceeded to shoot up all over the place, including among consumers and small business owners. So was the bounce all Trump related? No. The Trump trade had a huge help from the rest of the world. There was a lot of overlap with what came to be called the reflation trade. Though globally economic data came in above the expectations and commodity prices, most importantly oil, were recovering, the real market driver has been continued central bank liquidity injections as balance sheets continue to be aggressively expanded. Few really appreciate this. Michael Hartnett at the Bank of America Merrill Lynch noted that central banks, most specifically the ECB and the Bank of Japan, have bought $1 trillion of financial assets just in the first 4 months of 2017. which amounts to 3.6 trillion on an annualized basis, the largest central bank buying on record. As you recall, prior to this, we were running at about 200 billion per month. This is 8 years after the financial crisis, and we still need this level of injections and are adding this aggressively to it. Was the Trump trade good for everybody? No. Trump's fiery rhetoric on trade caused investors to flee emerging market assets, with the Mexican peso coming under pressure in anticipation of U.S. protectionism, and ideas floated by Trump and congressional Republicans for border taxes that would weigh on imports and had an adverse effect on U.S. retail stocks. That was reflected in their post-election underperformance. So what soured the Trump trade? Inaction, mostly. While Trump and Congress have rolled back some regulations, there's been less concrete progress in Washington than the markets euphorically and naively expected. What we have seen have been primarily executive orders. The big winners of the Trump trade in stocks, financial services, small caps, and construction have trailed the broad market since Trump's January 20th inauguration until this week's market surge reported to be as a result of the first round results of the French election. Reasons have included the failure to repeal and replace Barack Obama's health care initiative, slow progress on tax reform, and no sign of an infrastructure plan. Also, it started to sink in that immigration restrictions being proposed or put in place could be detrimental to economic growth. At the same time, the commodity-based momentum for the Trump trade has dissipated, with a slump in oil prices leading some to believe inflation may have peaked. So are the Trump trade losers the new winners? To some degree, yes. Investors have flooded into emerging market stocks, which are no longer seen as imminently under threat from protectionist measures. They're giving indications of a potential breakout being near at hand. So what's the outlook? Continued and higher gains in U.S. stocks and government bonds are unlikely without a reversal in the soured sentiment on America's near-term economic outlook. Yes, the proposed tax reductions are another shot, but the question is, when will they finally get implemented? And of course, a lot of them are already well priced into the market. That would mean overall that Trump and Congress needs to make progress on pro-growth initiatives, but a major stock correction isn't necessarily inevitable. Wall Street strategists weren't counting on stimulus from Trump to lift U.S. earnings this year, since U.S. corporations generally resisted making assumptions about tax reform in their 2017 estimates for bottom line performance. The likely roadblocks. There are serious congressional roadblocks facing the Trump administration and the Republican-controlled Congress, and I list them here. The 60 votes for a budget approval is something that no matter what, the Democrats will not allow. And Trump's going to have to give significantly to get any kind of budget through. The Democrats, for example, are not willing to put anything in it that has a border wall, financing in it, or they want Planned Parenting in it included. And so there's a real standoff there. The Freedom Caucus Republicans are demanding a balanced budget. So how do you get dramatic tax cuts, fiscal spending, and still balance the budget? The debt ceiling has got to be approved, increasing it, and we're looking at potentially the biggest increase in the fiscal deficit than we've seen in possibly decades. As we are about to release this video, there are proposed ways of getting around some of these hurdles. However, time will tell if that is the case, or whether more delays continue to occur, or whether the dam soon bursts with Trump's proposed policy initiatives suddenly lurching forward. We still don't know for sure. We're 100 days and nothing has happened. Just talk. Don't underestimate the Democrats' resolve to stop everything that's Trump. There is what can only be termed, and really, an all-out war presently occurring within Congress, and I don't see that changing. What are the policy exposures? Well, let's just look at a few of them. The failed Obamacare savings. Savings from Obamacare's repeal and replace are critically required to fund Trump's proposed tax cuts and to get anywhere close to a balanced budget. Though a breakthrough appears to be getting closer in terms of the Freedom Caucus coming along, it is still a work in progress and holding up other key economic initiatives. I'm more encouraged there than I was even a week ago, but again, it's just talk. We haven't seen anything on the table. The thing that concerns me most in the policy is the second one, and that is the tax cuts, because what we're seeing already is falling tax receipts. This is a major concern. Look at the federal taxes. In March, the U.S. Treasury brought in total receipts of $216 billion, below the $228 billion last March versus outlays of $392 billion, resulting in a deficit of $176 billion, more than the $167 billion expected and $68 billion more than the previous year. In March, the U.S. government had its biggest one-month outlay ever, spending $393 billion, $57 billion or 17% higher than a year ago. For the fiscal year through March 31st, the total U.S. budget deficit was $527 billion compared to $459 billion a year ago. Remember, this is all before any possible tax decreases. Over the past 12 months, the deficit stood at $652 billion, compared with $461 billion a year ago, an increase of over 40% year over year. On a 12-month run rate, the U.S. deficit stood at 3.1% of GDP. A year earlier, that figure was a third less, or 2.2%. Government receipts on Treasury statement were $3.2 trillion. This amount was 1.3% lower than the $3.3 trillion reported a year ago, and was the fourth consecutive month of declines. This was also the biggest drop since the summer of 2008. Every time since at least 1970, when government receipts turned negative on an annual basis, the U.S. was on the cusp of or already in a recession. That changes everything in the current narrative if they were to talk about or announce or be aware of that we're in a recession. Much of the collapse in receipts is due to a double-digit percentage plunge in corporate income taxes, which begs the question on what are the real corporate earnings that are going on right now. This is the federal level. What about the state taxes? They're also plummeting. Year-over-year growth in state tax revenues slowed dramatically in the last 2 quarters. State tax revenues rose by an average of $40 billion per year between 2010 and 2015, but declined $23 billion annualized in Q2 2016 versus 2015. Most of this deceleration in state tax revenues reflects softer individual income tax receipts, but declines in corporate income taxes and natural resource severance taxes incurred when natural resources are extracted in a given state also played a role. This has subtracted an average of a quarter percentage points from GDP growth, as other indicators support the idea that municipalities have indeed pulled back on spending. The weakness in local and state government spending relates to both capital investment and current consumption. In a nutshell, the weakness in state and local government spending, particularly on capital investment, looks real and appears to be driven by fundamentals. How do you lower tax rates and balance a budget, which the Republican Party and the Freedom Caucus demands, and do it in an expedient fashion? I don't know that this is possible. Let's talk about another one, this $1 trillion in infrastructure funding. You know, what's ironic here is though both the Republicans and the Democrats support and have proposed individually infrastructure stimulus spending, it is difficult to see them agreeing on an actual infrastructure bill. Not where the money is going to be spent, on which infrastructure project, which in itself will be a whole discussion, but rather just simply one of philosophy. We need to understand that. Republicans believe infrastructure spending should be financed by the private sector through PPPs, which stands for private-public partnerships. The government puts up little money, therefore there's minor budget deficit increases, theoretically, but makes tax treatment and regulatory restriction removal conducive to the infrastructure projects becoming attractive to investors and developers. Since ownership of the infrastructure is held by the private investors, it is important to have project break-evens within relatively short periods of time, 10 to 15 years, and this is how it's achieved. This also means what people need to appreciate is tolls and user fees on those projects. That is, i.e., airport user fees and toll road taxes and bridge taxes, etc. The Democrats, on the other hand, believe ownership of infrastructure projects should be held by the government. Therefore, the financing is through government debt and bond offerings. This means budget deficit spending. Completely different tacks for the same goal. However, getting them to agree on this, I think, is a showstopper, and that's another key cornerstone of Trump's economic policies. So what are the coming shocks? Because in spite of everything I've said, there's other waves that are happening here which we need to be really cognizant of, which change, as I said earlier, all of the narrative. The first and most obvious is a U.S. recession. The Federal Reserve has initiated the 15th tightening cycle since 1945, shown in this chart. Conspicuously, in 80% of the prior 14 episodes, recessions followed, with outright business contractions being avoided in just 3 cases. What is notable today is that the economy is in the 93rd month of this expansion, a length of time that is well beyond periods in prior expansions where soft landings occurred. That was 1968, 1984, and 1995. Academic studies reflect that economic growth slows with over-indebtedness. Thus, a powerful negative headwind is reinforcing the present monetary tightening. Monetary restraint is taking hold in all the different ways of measuring the Fed's actions in late-stage expansion, where historically the result were either a recession or a financial crisis or both. This is relevant because the pent-up demand from the prior downturn has been exhausted. Thus, the economy is extremely vulnerable to a shock, which could lead and would lead to a recession. Regardless of whether this was an associated recession, the last 10 cycles of tightening all triggered financial crisis. In conjunction with the non-monetary determinants of economic activity, referred to as initial conditions, monetary restraint served to expose over-leveraged parties, and in turn, financial crisis ensued. We are clearly due for a U.S. recession. Even if not politically correct for us to speak about that R word, it nevertheless is either imminent or, in fact, we could possibly already be in it. Another area is blatant, a destabilizing geopolitical event. And we have them in spades at heightened levels that I haven't seen in a long time. And I have had neighbors ask me how serious the conditions are right now because their children are actually frightened and asking them when they hear these things on the nightly news. That tells you we've reached a new dimension here, and I'm referring to North Korea, I'm referring to cruise missiles into Syria, and I'm talking about the Mohab bomb in Afghanistan, which has caught everybody's attention. Prior U.S. presidents have seen their presidencies consumed by an unexpected event, a geopolitical event. Examples: Jimmy Carter and the Iranian hostage situation. It and inflation cost him his second term. Even Obama, for that matter, spent most of his presidency getting out from under the 2008 financial crisis. George Bush II, it was about 9/11. President Trump has any number of potential swamps which could consume or are already beginning to consume his presidency. Ever mind getting all of these initiatives, economic and policy initiatives that we've just discussed, through Congress and what it's going to take to make that happen. Another headwind here, which everybody is not talking about, is the magnitude of the global trade slowdown. The global trade slowdown tsunami is getting nowhere enough coverage. It is serious and getting serious fast. Our view on bond yields, for example, and the U.S. economy does not change if the Fed further boosts the Fed funds rate this year. Any additional increases will place further downward pressure on the reserve, monetary, and credit aggregates, as well as tighten bank lending standards. Such actions will not allow the economy to regain the economic momentum that was lost in 2016 and in the early part of this year. Thus, in our view, the secular low in bond yields remains in the future, not the past. This tells you what you might expect for equities by the end of 2017. So, in closing, remember, the answer will be, and as always, to print more money. It is the only answer politicians will ever agree on. Invest accordingly. When you're printing money at this rate, it is tough for financial assets to fall in a situation like this until a crisis occurs. Then they disappear and evaporate in an instant. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2017 turn out to be an outstanding investment year for you and your family. Thank you for listening.